Hello and welcome to our third video in our fourth quarter of investment current series. I'm Tim Chubb, Chief Investment Officer here at Girard. I hope you're having a fantastic start to your year, and we're looking forward to sharing with you our economic and market outlook for the year ahead. As we enter the new year, the global economic landscape is in flux. Following the sharpest monetary policy tightening in 4 decades, global growth has certainly been more durable than expected and is entering the new year with momentum. While the risks of growth are more balanced headed into 2024, we expect global growth to slow a bit further from the near-trend pre-pandemic rate of 3% last year. Higher interest rates and quantitative tightening continue to filter through the economy, creating pressure on growth. And this subdued growth environment will likely bring inflation back to the 2% range, the target for the Fed and other global central banks, allowing policymakers to cut interest rates to less restrictive levels to prevent growth from stalling and the unemployment rate from rising significantly. While this implies the world economy could experience a soft landing, that is avoiding a recession with moderating inflation, it still may be bumpy. There remains a reasonable chance of a mild recession as countries grapple with higher interest rates, fading fiscal policy support, and geopolitical conflict that could add inflationary pressures beyond the control of central banks this year. In the United States, growth surprised the upside last year as consumers depleted much of the over $2.25 trillion in excess savings accumulated during the pandemic. Going forward, consumers will be increasingly reliant upon wage gains, to a lesser degree, the Federal Reserve easing to support spending. We'll discuss this more later in the video, but the labor market has shown signs of softening recently, but there are no meaningful cracks. The consumer will be a key issue for the continuation of the U.S. economic vigor and whether or not consumption eventually wilts in the face of the lagged effects of higher inflation and elevated interest rates. With that said, the U.S. budget deficit, which remains at 6 or 7% of GDP, historically unprecedented for a non-recessionary expansion, also supported the economy last year and is expected to grow continuing in 2024 despite recent concerns in Washington. In China, last year, growth faltered as the housing sector, which makes up nearly a quarter of GDP, fell into crisis. Weaker than expected growth following the reopening of the Chinese economy led to a raft of stimulative measures announced by various levels of government, which should lift the prospects this year, despite muted prospects in the long term. In the Eurozone, stagflation plagued much of 2023, but conditions will likely improve later in 2024 as disinflation progresses. Unfortunately, however, a recession appears likely in the first half of the year, with the recent data showing a slight contraction in the Eurozone real economic growth. Germany and other industrial-sensitive economies weighed on economic output recently, while more service-driven economies continue to outperform. While 2023 was all about the inflation story, we expect that to be less so the case in 2024. After some stalling in the disinflationary progress last summer, lower energy prices, some cooling in the labor market, and slowing house price appreciation should allow both headline and core inflation rates to move lower over the course of 2024 and closer to the 2% target established by developed central banks. Recently, this global core inflation has actually fallen to the annualized rate of 2%, and we expect that both service inflation and wage growth will continue to slow gradually in a lagged response to an improving supply and demand balance in the global economy. Here in the U.S., we fully have shared in that global disinflationary trend, and recent data has suggested that the 6-month annualized rate, which is something that the Fed has repeatedly emphasized in the last few months, stands at 1.9%. This year, the labor market continuing to rebalance is critical for inflation to fall further, bringing wage growth more in line with the rate of inflation. A softer labor market is especially important for services inflation, with goods price inflation already falling below 2% and essentially flat year over year. Now that the Fed and other global central banks have finished raising interest rates, markets have been anticipating when and at what pace the first rate cut may occur. But given our expectation for slow but still positive economic growth, both in the U.S. and globally this year, the Fed may wait until the second quarter to gain further confirmation that the war on decades high inflation is finally won. Following the December Fed meeting, where officials revised their outlook for rate cuts from 2 to 3, investors responded aggressively, pricing in 6 rate cuts within weeks. We pushed back against this slightly, especially with the first rate cut coming in March, with the ongoing resilience of the labor market being a key theme. We expect the Fed will proceed cautiously, potentially lowering rates at every other meeting starting sometime in May or June. Following inflation concerns and additional rate hike fears triggering a 10% dip in stocks from July to October, the markets surged in the final months of the year as improving inflation data encouraged global central bankers to pivot from tightening monetary policy this year. Further appreciation from these levels will really rely on earnings growth rather than multiple expansion or the price paid for a dollar of earnings. A clear signal of future Fed easing and improving breadth of earnings growth are potential catalysts for this year, and a soft landing should rule out major earnings contraction, but the consensus forecast for a swift earnings recovery leaves us quite a bit skeptical as cost pressures still remain, especially from the sticky wage growth and elevated financing costs that have plagued companies the last couple of years. Top line or revenue growth may disappoint from reduced pricing power and slowing demand. Regionally, the Eurozone economy is vulnerable as we discussed, and profit margins may remain under pressure as companies increasingly struggle to pass on higher wages and interest costs to their customers. While the economy lacks a clear engine to return to growth in the near term, a gradual recovery could materialize in the back half of the year, presenting some upside to earnings and a re-rating of multiples before the economy is expected to improve. In emerging markets, we saw economic data broadly surprise to the upside over the course of the fourth quarter, and earnings nearing an inflection point following a protracted decline really leave us excited about emerging market economies ex-China. Unlike developed markets, emerging market profit margins are near cyclical lows and have room to rebound as global activity continues to improve. Moving to fixed income, higher rates mean that bonds are as competitive with stocks as they have been since before the global financial crisis. We rely on bonds to provide stability in a multi-asset portfolio. Coupons generate income, and bond prices tend to rise when economic growth slows and rate cuts are necessary. Given the increase in yields within the last several years, bonds are likely to deliver on both fronts, with yields reaching highs not seen since 2007 following a generational reset in bond market pricing. The rate reset means that core bonds may now be poised to deliver strong forward-looking returns beginning in 2024, with modest price appreciation as rates fall, combined with an attractive starting yield. Undoubtedly, it has been a brutal stretch for bond investors, but we think that the end of the central bank tightening cycles and cooling inflation will offer some reprieve and bring stability back to the asset class. Lastly, we see it unlikely for corporate defaults to reach close to historical levels given the strength of corporate balance sheets following the post-global financial crisis era of ultra-low interest rates that allowed companies and consumers alike to refinance their debt with lower interest expense. With default rates in check, the concern around corporate bonds is more of a function of higher financing costs impacting profits, with interest rates still elevated. With the Fed set to cut interest rates this year, hopes for a soft landing have been growing, and undoubtedly the economic data has recently surprised to the upside. Risks are more balanced, but risks do still remain for the U.S. and global economy to slip into a mild recession or experience stagnating growth this year. With the real federal funds rate now at historically restrictive levels relative to inflation and a continued steady reduction in the balance sheet, there is a growing risk that the Fed may be tightening policy too aggressively and may have to be quicker to ease should the economy slow more than expected. That said, the U.S. consumer has remained extremely resilient, and as my colleague Mark pointed out in a prior update, was the primary source for better than expected growth last year. With inflation moderating quicker than markets anticipated, real income, that is, income growth or wage growth less inflation, has been increasing at a solid clip, which is critical for consumption. This could lead to a reflationary environment, which is great for the growth outlook, but will imply higher interest rates are here to stay a bit longer than what market participants are expecting would be necessary. As we sit here in the first few weeks of 2024, it's important to recognize that the U.S. and global economy are likely in the later stages of an economic cycle, and also acknowledge the potential for other outcomes, especially in the back half of the year. In summary, our investment team expects the economic landscape to reflect the final stages of healing from the disruptions from the pandemic. We expect the U.S. economy to decelerate to below trend growth with easing inflation as the Fed sets to respond by lowering interest rates. The markets and the economy are set to pick back up where 2023 ended after finishing the year with one of the biggest rallies in history for both stocks and bonds, and sense that the markets may need to take a bit of a breather before the next catalyst emerges, with an acceptance that a soft landing may be a bit different from what the market expects. In this slide, we attempted to summarize 3 economic scenarios this year, how the markets would perceive these outcomes, and the potential implications for the back half of the year. In our view, we remain in this late cycle environment during which markets will oscillate between accelerating and decelerating growth environments, like those listed in the bottom two scenarios, as central banks transition from higher for longer to we're likely done hiking rates and will be easing in 2024. Well, we sincerely appreciate you tuning in, and if you have any further questions about the information in this video or to learn more about Girard, please contact us at meetgirard.com.